Hey, welcome back to the channel. Today we get to talk about an exciting topic, taxes. So, as a nomad, expat, whatever you like to call yourself, traveling around the world, living in one spot, not in the US, doesn't matter. You can take the foreign income exclusion and save money on taxes. But there are some pitfalls. Watch through this video because at the end, I go through a little bit more complicated example that is probably a tad more practical for many people and show you the pitfall of a tax, uh, not a loophole, a tax trap that if you don't know is out there, it's going to bite you. Luckily, I've got good tax people and it's not biting me. And that's because I got good tax people. I'm sharing some advice that I've paid for from them with you. As always, go find an actual tax expert and don't take your tax advice off some Yahoo on the internet. Let's get into the numbers. Here's a spreadsheet, which is always fun. Okay, let's go ahead and go through this PowerPoint here. Now, this is where it gets fun. So we're talking about foreign earned income exclusion. If you've never heard this term before, go ahead and give it a Google. But basically what it is if you're working outside the United States, the income is considered foreign earned. Even if you're being paid by a U.S. company, doesn't matter who's paying you, it matters where you're working. So if you're living outside of the country and you pass either the physical presence test or the bona fide residency test and you're making money, you can qualify for the foreign earned income exclusion. This is a good tax savings. But let's talk real fast what a physical presence test is. You basically have to be outside the country for no, let's see, let me rephrase this. You have to be not in the country for any more than 35 days, if I remember the number right. Check that out. But basically, you've got about a month that you can be in the US. The rest of the months, you've got to be out of the US. And the best thing is to totally be out of the US because if you're in the US for even that 30 days, it cuts down on what you can exclude. The other way to test for this is something called a bona fide residence test, which uh, it's very subjective and you can classify as a bona fide residence through uh, being having your presence not in the US, basically declaring your life outside the US. You have a home, you're living there, you belong to clubs, you have no intentions of returning to the US anytime soon. That's a bona fide residence test. Most people do the physical presence test because you don't have to measure it from the beginning of the year to the beginning of next year. You can do partial years with it. It gets complicated. I have another video that breaks this out, so I don't want to dive into that. This year, in 2025, you can exclude up to $130,000 of your income. So that's pretty awesome. That's a good tax savings. However, there's a lot of subtleties in this, and you want to consult a tax expert. In the simplest case where you're W-2, you only make 130, you paid your taxes and your Social Security withholding automatically, it gets pretty easy. If you're 1099, it gets a whole lot more complicated. So let's go into this example. All these examples assume you're married filing jointly. Why? Because that's what I do. Okay. Okay, so let's take a simple 1099 example. You make $130,000 in 1099 income. Not bad. It's a pretty good salary, especially if you're living off abroad, not in Europe. You meet the physical presence test, so for the entire year, so you can exclude the whole 130,000. So that's 130,000 salary minus 130,000 in the excluded income for foreign income exclusion. You owe zero taxes. Yay! Not quite. Wrong. Sorry. You do not get out of your self-employment tax. What is self-employment tax? Basically, that's your Social Security and Medicare rolled in. If you're W-2, you still pay this. Your employer pays half of that and you pay the other half out of your check. That's the FICA withholdings that you see on your paycheck. If you're 1099, you're the employee and the employer at the same time, so you get to pay both halves. That's not an insignificant amount of money. So it's 15.3%. So of your $130,000, you still have to pay that. That is not excluded. So 130 times 0.153 gives you 19,890. You're on the hook for that. And you've got to pay that. You have to pay estimated income taxes too. Don't forget to do that because the IRS loves to fine you for that if you screw it up. So don't get deluded into thinking that that 130 is tax-free because it's at the exclusion level. you still owe for your self-employment tax. There are ways that you can reduce that. Uh, Videos will talk about S corps. Those don't really help you much when you're trying to take advantage of the foreign earned income. If you're making a whole lot more, like way more than 100, they're like the 200,000 plus, well, that's a whole different ballgame. Consult your tax advisor. But if you're just making in the mid hundreds, 130, 100, 200,000 in there, it usually doesn't help. But again, consult your tax advisor. These examples do not consider S corp because of this tax range. It doesn't seem to make sense to me. So let's look at a more complicated example. So let's get some mixed income. Let's say you're hanging out abroad, but you're married to somebody who pops up, does some work in the US for a while. So you've got some W-2 US income and you've got foreign earned income. So let's say you've had a pretty good year. At least I think that sounds good to me. 150,000 of 1099 income abroad. You meet the physical presence test or the bona fide residency, so you can use the foreign earned income exclusion. Your spouse went up to the US for a few months and made 20 grand of W-2 non-exclusionary income. So that's straight 20,000 W-2 income. You can't deduct anything off that. But let's say you have also $20,000 worth of business expenses. Okay, that's legit. If you're traveling, you've got to buy expenses to make your income. That's a totally legitimate expense. So let's say you've got $20,000 worth of expenses that you can legitimately legally take off your taxes. So your total income is 150,000. Well, your income is 150,000 total after you take the 170 of your 150, your wife's 20, then you subtract off your $20,000 worth of expenses. You're right back to the 150,000 income. You take off the 130,000 foreign earned income exclusion. Plus, don't forget, you still have a standard deduction. So if you're up here, you've got a 31,500 combined standard deduction. So you're back down to zero, right? Well, you already know the answer to part of this. Wrong. You know you still owe the 130, the self-employment tax. That didn't go away. Now, your spouse's Social Security was deducted out of the paycheck, half from her paycheck, half paid for the employer. So you don't have to worry about that one. That was taken care of for you by their employer. But you still owe yours. So you still are on the hook for that nearly $20,000 in taxes. But that's not it. Let's walk down this a little bit more. Of that 19,890 that you pay out in self-employment taxes, you can actually deduct half of it off your taxes. That's kind of cool. I mean, it'd be better if you didn't have to pay it at all, but it's kind of cool you can deduct it off because in a normal case, you would only be paying half of it anyway. So you can deduct half from your income. Awesome. But it gets a little murky here. You don't get to do the full $130,000 foreign earned income exclusion because you took deductions on the business expenses. Why is that? It makes no sense to me. But this is what the IRS says. And I will leave you the link to the IRS tax code. Because you took deductions, you have to take how much you would have used for foreign earned income, the whole 130, divide that by your actual income, your gross receipts of 150. That becomes a ratio of what you can take off for expenses. So you take that ratio times what you would have taken off for expenses, the 20,000 business expenses plus the 9,000 change, half of your self-employment taxes, and you only actually can deduct 104,000 and some change for your foreign earned income. Does this make sense? No. Is it US tax law? Yes. So you want to go look this up. You want to get advice from a tax professional because this will bite you in the butt if you don't know this, because you don't get to take it all 130 off. You can only take 104,000 off in this instance. Again, look this up. Don't trust me. Feel free to look it up. So of the 130 of the net income you have, you can only exclude 104 of it now. You can still take off your 9,900, the half of your self-employment tax that you paid. You got to add in your wife's 20,000, and your total taxable income now is 36,000. Well, that is still a heck of a lot better than the 170 or 150, I guess, after gross business that you would have had. So, tax on 36,000. It's an IRS tax bracket. If you don't know, the tax bracket for married filing jointly at 36 is 12%. You're all good, right? Well, as you can guess, no, you're not, because the IRS hates you and they have one more little thing for you. You don't calculate the taxes owed based off your gross after deduction, your net after all the deductions. It's a more complicated formula. I didn't even write it out. That's why I have a tax guy. The taxes are actually calculated at what you would have been taxed minus the tax on the excluded income. And I will tell you, it's going to come in higher than 12% of 36,000. So you've got to be careful. You got to do it. It still is going to be a lot less tax than what you would pay if you had to do this in the US. You reduce your self-employment tax by having more expenses to deduct, but the more expenses you deduct also reduces your amount of your foreign earned income exclusion that you can take. So it's a balancing act that you want to look at. Of course, keep yourself legal and safe, but you do have to weigh off and you got to run the numbers to see what balances out for you. You still get to reduce your taxes quite a bit working abroad, but it's not as much as it just seems on the surface. You have to be careful, but you still can save a lot of money with this. So this gets complicated. If you like running numbers and doing all the research, go for it. I'll give you some pointers here. This link to the IRS down here, I will put in the comments so you can go look it up. The calculations that I'm talking about right here, don't have the link handy for that. But again, you can check that in tax law. You can Google it. My advice, as always, hire a tax guy. The reason I know this is because I hired a tax guy. His name's John. He works over at Greenback Tax Services. I will leave a link for them. They've done good for me. John saved me a lot of money, made me a lot of money on tax savings. So they're not paying me anything. I use them. There's other services. Check them out. I'll share the link, of course, with the one I use, but go check out your own if you want. But the point is, be careful with your taxes. If you just look at the sunshine side of it, you will grossly underestimate your taxes and you'll have a big bite on April 15th. Oh, June 15th if you're living abroad. So notice I didn't talk at all about state taxes. Hold that thought. Okay, state taxes. As you notice, I did not include anything on state taxes. The reason is, if you're a good expat, you don't pay them. You leave whatever high tax state you're in. If you're living in a state that has income tax, move. Move your declared residency outside of that state. Florida, Texas, South Carolina, Washington, all tax-free. Vegas, not Vegas, Vegas is a city. Nevada is tax-free. I think Tennessee is too. I don't know. You can Google it. Move yourself to a tax-free state so you don't have to deal with this at all. Then you only have to deal with federal. You take your foreign earned income exclusion, you watch your expenses, and you're going to save a lot on taxes. But you do have to be careful. You do have to hire a professional. I hope you find this interesting, and I hope you can save some money with taxes legally. You don't get bit by the IRS. We're not talking about FBAR or anything in this video, but don't forget about those. If you don't know what they are, look them up, get your tax advisor on them. Hope you enjoyed it. Have a good day and hope to see you on the road traveling sometime.